Are you ready for the summer? Are you ready for the summer?
I'm always ready for the summer. What? What's going on this summer? What are we
I
doing?
know, what are you doing? What are you doing this summer?
Grand Canyon.
No. That's not what I mean.
We're going on a cruise?
No, that would be nice, but no, not this summer.
We're going to Wally World. Come on.
Yay! No. What is going on this summer?
We're going to Disney World.
No.
Everybody goes to Disney World in the summer, DeLynn.
August 1st. What's going on August 1st? Come on.
Oh, that August 1st.
It's not quite as exciting as Disney and cruising and stuff like that.
We are going on a cruise, though, August 1st.
No, we're not going on a cruise on August 1st. August 1st, the new rules, the new regulations. If you are in real estate, mortgage, title, anything like that, you certainly know what's going on come August 1st, huh?
Just go to Wally World. Forget about it.
Boy, wouldn't we love to.
Hello, everybody. My name is Barry Horvath, and this is Moving Forward TV, your local market update.
Hello, and I am DeLynn Gaston. Thanks for joining us today.
Hello.
It seems like I know. It seems like forever, huh?
Yes.
Since we've been filming. Sorry, we've had so much going on.
Yeah, we've been planning our August 1st vacation.
No, we are not going on vacation August 1st.
I can't wait. We're going to Wally World.
Meanwhile, everybody's like cringing.
Yeah. So if you're not aware, if you've been hiding under a rock or just in a cave, August 1st is bringing out all these new, wonderful new rules.
Yes, new federal guidelines. You know, in the mortgage and real estate world, there's been so much changing over the last 7 years.
People call you all the time.
People call me all the time
about this.
So many changes, and of course, the point of the show, as you know, is to keep you guys all up to breast on the shows.
We want to
educate them on the changes that are going on in the industry. So consequently, some of the bigger changes are coming right now.
Like
we've been talking about it for a long time.
There's a whole new set of rides at Wally World. We got to educate you guys on that on August 1st.
Remember that big stack of, over 1,000 pages of changes that the CFPB came out with, and some of the things that everyone was alluding to. They're happening August 1st.
Yes, and we're not going to talk too much about CFPB, which is the Consumer Financial Protection Bureau, which we have a special guest today who's going to teach you all of this stuff.
Yes, we're sharing the limelight.
Yes, and his name is Jeremy Potter. He is the Chief Compliance Officer and the General Counsel for Norcom Mortgage out of Connecticut. So,
and I just love Jeremy, and there's been so much stuff that has come out on
Does
this,
your
and
husband
it's so
know you
confusing.
love Jeremy? Have you told him?
Yeah, I know he does now.
Are you going to let him know for his birthday?
But
wait.
There's been so much coming out.
Sorry,
and I know,
Jeremy, just kidding. I'm only kidding.
I know
and I'm
there
sorry,
are
John. Happy birthday. Sorry.
I know there's a lot of confusion that's out there, and I love the way Jeremy has brought. He doesn't speak he doesn't speak attorneyese.
No.
He speaks English. He speaks normal. He really breaks this down in very easy to understand. I know there's a lot of confusion with people out there. Jeremy did a wonderful job of breaking all of this down.
Yes.
What we will say is, please go to the website www.easymortgageanswers.com easymortgageanswers.com and print out the documents for this.
You're going to want to have it in front of you when you watch this.
There's two documents. It's LE, the loan estimator, right? And then the closing document, CD. They have all the new acronyms and everything too. So the closing documents, print those out because you're going to want to have those in front of you so that you can follow.
He's going to hit everything for you. Rather than us bore you with information, we thought you'd get it from one of the top sources in the country here.
Yeah, actually he is. So enjoy this.
Yes.
Everyone's story is different, so why be limited to just one or two options? With Norcom's Norflex Home Loan, you're given the flexibility to tell your story. Pick your terms from 8 to 30 years, all while maintaining a low, fixed mortgage rate. You can pay off your loan more quickly or choose a term based on your budget and timeline. Whatever you do with the Norflex home loan, make it part of your financial plan. Norflex, short-term, long-term, your terms. Apply online at norcommortgage.com.
Hello everyone, thanks for joining me today on our Respatila conversation. This is the first of what I'm sure will be many conversations and trainings on this rule moving forward. The rule itself is the integration of both the disclosures on the front end of the loan and at closing. So as you may have heard, the big headline, the GFE and the HUD-1 are going away, and the CFPB has combined those forms into two new forms. The first is called the loan estimate, taking mostly the GFE and the initial till. It's due to the consumer 3 days after application, and taking the HUD-1 and the final till and combining it into a closing disclosure. You may hear this rule referred to as the RESPA-TILA rule, as I just called it, the TILA-RESPA integrated disclosure rule, which is what CFPB calls it. They also call it TRID, the acronym. And you might hear it called the GFE rule or something like that. What we're going to talk about today is a brief overview. Hopefully I can give you the broad strokes of the rule. We're going to go through a couple of the documents. I want to show you high points and then talk about some of the challenges and the other things involved in this rule that are really going to give us some issues over the next few months. But I want to reassure you, we're going to be doing deep dives on the loan estimate, on the closing disclosure, on filling them out, on the different policies and procedures associated with it throughout the next 6 months. This is truly an introductory conversation that we're able to get comfortable with at least the top level highlights, and we'll go on from there. So I'll jump right in. I've already told you a little bit about where this rule fits in our business, and we'll start with the loan estimate. So the GFE and the initial till will become the loan estimate. The loan estimate looks very similar to what, I shouldn't say it looks similar, what I should say is it has almost all of the information that the GFE and the initial till currently have. So they haven't really changed what we're showing the consumer, with a couple of exceptions, but they have rearranged the format and the style of how we're going to show it to the consumer. So for example, the loan estimate has the initial loan specifications, the loan details at the top. You can see that it has rate lock information if it's a locked loan. It has one new item, the loan ID number. For those of you in the wholesale channel or in the wholesale business, this loan ID number is a new feature that currently isn't found on the GFE. It won't pose a major problem. Our system will automatically add the loan number to the list. And for brokers, they don't have to know the lender's unique identifier. They can leave that space blank if they don't know the lender that they're sending the loan to. We would then disclose our loan number when we receive the loan into our pipeline. You'll notice that the document also contains loan terms. These are loan terms that you would typically find on the GFE, perhaps a little bit more prominently on the loan estimate. And then you move down and you see some of the other projected payment tables. One of the nice things about coordinating all four of these documents into two is that the font, the tables, the organization style are all the same. So you have these types of tables: payment calculation, principal and interest, mortgage insurance, escrow. These are the tables you'll see on the front end, on the closing disclosure, and if you have, say, an adjustable rate mortgage, you would see these same tables for the different periods of the adjustable rates and the payment tables on that disclosure. So it's really a nice feature that they kept everything consistent. I think you'll also find as we move through this that it is pretty easy to understand. So while we do have to go through another update of the documents, we're at least doing it with documents that are pretty self-explanatory. At the bottom of page 1, you'll see closing cost to close. Estimated closing costs, estimated cash to close. Again, information that's currently found on the GFE, just displayed in a little bit of a different way. So in the interest of time, I'm going to jump right into page 2. That about covers page 1. On page 2, you'll see basically two columns, left and right. On the left, you have loan costs. The big difference here is the organization. On the GFE, it tracks to the boxes that we're all used to seeing. The origination charges at the top, boxes 3 through sometimes 11. I guess it's always 11, but sometimes they all have fees and figures, and sometimes they don't. That has all been flipped on its head, whereas you would see sort of the top level numbers on the GFE. Here, they do it in alphabetical order, an A through J series, and then all of the items below each category are alphabetized. So you have to have it in alphabetical order, and each fee that you show on the loan estimate needs to appear on the closing disclosure. So there's an ability for the consumer to track the loan estimate to the closing disclosure. One of the unique features of this rule that has made a change is that if you plan on charging a fee on the closing disclosure, or a fee could arise during the transaction, you need a placeholder for it on the loan estimate to alert the consumer that it could arise during the transaction. So for example, I use a final inspection fee. Final inspection fee may not be needed on every loan, but if the appraisal comes in subject to and the underwriter would issue a condition for a final inspection, that could arise. So we would want to have a place for that on the loan estimate, even though it would be blank. We don't know if it'll be charged, but it has to be there to hold that line item for the closing disclosure. One slight change from our practice today. Under C, you'll see some services you can shop for. This is all the things you would expect to see, again, from the GFE, but brought over in an alphabetized way in this format. On the other column, you'll see other costs. These are your taxes, recording fees, prepaids, the escrow payments, and then of course lender credits should there be any. This is the format of both documents, and then you'll see on the cash to close table on the bottom right hand corner. Again, information that's already found on the GFE, but here on the closing or on the loan estimate. Moving on to page 3 of the loan estimate, you'll see two things I want to highlight for additional information on this loan. Top right, you have all of the mortgage broker's identification. It'll be blank if it's a retail loan, and it'll have the information there if it's a wholesale loan. And then of course our information and our originator's information is always going to be on the left. The comparisons is the same information you would likely find on an initial till with one addition. So there is a few things they've added. This is one of the big ones. They've added the total interest percentage. They're calling it the TIP. The total interest percentage is a somewhat startling number to a lot of consumers. So in the example we're showing you here, 69.45%, the amount of money paid over the life of the loan if you make all the payments that goes towards interest. In a lot of examples in some of the test cases I've seen, this number can go as high as 81%, 82%. It is really kind of a sticker shock moment for a lot of consumers. So to the extent that you could figure this out mathematically from the information that's on the till, say the finance charge, for example. If you took the finance charge versus the total loan amount, you could come up with your total interest percentage. But to have it displayed this way on this document is pretty startling for a lot of people, so that may take some explanation. I mean, to the extent that you're already used to explaining the APR, this will be one additional figure that you'll have to explain as well. Scrolling down a little bit, you'll see there on the bottom of page 3, there's two other sections I'd like to talk about. One is the other considerations. Under other considerations, you'll see all the information again from the till, and then you will see the assumption information, the late payment, refinance information, and then under servicing, I just want to make one quick note. We are working with the CFPB to try to get them to add a box. You'll notice that this document says we're going to service your loan or we're not going to service your loan. We're going to get another box hopefully that says we may service your loan, because we don't always know, obviously, at the issuance of the loan estimate, which loans we're going to be servicing and which we won't. And then the last box on this page is confirm receipt. It's a signature line. The CFPB has stated that if you're going to have this document signed, you need to have it signed by every consumer. And if you're not going to have it signed, then no consumer should sign the document. So it'll be a corporate policy lender to lender. Again, this is one of those things we'll be pushing out as we finalize the formatting and some of our other policies around this disclosure. But just so you know, lender to lender, that will be a decision that everybody has to make. That's essentially a brief run through of what the new 3-page initial document will look like, the loan estimate. There's a couple of features I want to talk about before we move into some of the other issues and eventually into the closing disclosure, and that is the change in application date. So Integrating of these two regulations also meant that you had to deal with the inconsistencies between RESPA and TILA. For example, business day is one of the inconsistencies. They could have coordinated the rules so that business day was a defined term for both ends of the transaction. They chose not to do that. So the loan estimate falls under RESPA's definition of business day. The closing disclosure falls under TILA's definition of business day. What does that mean? RESPA says a business day is any day that your operations are substantially open for business. So that will help us formulate how we're going to issue the loan estimate and what days we're allowed to count. For example, Saturdays. We cannot count Saturdays towards the 3 days if our operations are not substantially open on that day. The closing disclosure is under Truth in Lending. Truth in Lending says any day that is not Sunday or a federal holiday counts. So for that one, Saturdays will count. The other thing is the definition of application. So what triggers the clock ticking on the 3 days to issue the loan estimate? RESPA had a definition. Today's definition of application under RESPA is 6 key pieces of borrower information, and the 7th, what a lot of people call the catch-all, which is 6 pieces of information about the borrower and any other information the lender needs to make a credit decision. Under the new definition, that 7th was removed. So it's just the 6 key pieces of information about the borrower. That will trigger the need for a loan estimate. Not that that 7th item was that impactful to a lot of lenders, but it did offer some wiggle room. To the extent that that wiggle room has been removed, we will now be coordinating, again, in future trainings, how we're going to get the loan estimate out when the system has the 6 pieces of information. One thing that the CFPB did recognize is that borrowers will give you those pieces of information at various times or in a various order. There is no consistency necessarily to how you're going to get that. So what they said is be strategic about how you collect these things. If you think that there's going to be an issue with getting a loan estimate to a consumer within 3 days, make sure that you're collecting the information in a uniform and timely manner so that you can comply with the law. The rule also goes into what documents or information you can collect and verify prior to the intent to proceed. It didn't change the importance of the intent to proceed, but it did highlight it in a way that it hadn't been highlighted before. I think it shines a brighter light on the intent to proceed. So, for example, you can still be asking for bank information, asset information, say like account numbers. You can still be asking for employment information, but you can't do VOEs and you can't verify employment prior to the intent to proceed. You can talk about some purchase terms if it's a purchase transaction, but you can't ask for a copy of the purchase and sale agreement until after the intent to proceed. So this new milestone or this new moment in time will, I think, cause more disclosures of loan estimates and also a brighter light on what you can take beforehand and what you need to wait to take till after you have that intent to proceed. The last thing that they did clarify under this rule for loan estimate purposes is tolerances. We've all talked about the no tolerance, 0 tolerance, 10% tolerance buckets. They have sharpened the no tolerance buckets and they've added one item, giving us a little more leeway, in the 10% bucket. The no tolerance items are fees paid to the lender or the creditor, fees paid to a mortgage broker, or items paid to a mortgage broker, and fees paid to an affiliate. Any of those, there's 0 tolerance. Whatever fee you put for those categories on the loan estimate has to be identical, or you can't collect any more than that on the closing disclosure. Fees where it's an unaffiliated company, but the consumer is not allowed to shop for the service. So your appraisal report, if it's not an affiliated company, your credit report have also become 0 tolerance because you're not allowing the consumer to shop. So that will be another thing that must match. The 0 tolerance is still subject to a changed circumstance. To the extent that you have a valid changed circumstance under RESPA, you can still go with that schema. That strategy hasn't changed. But they did add recording fees to the 10% bucket. So where they have recognized that recording fees sometimes require the 10% variance. Other than that, the general RESPA culture has stayed largely the same. Again, the document looks a little different, and we'll talk about how the loan estimate interacts with the closing disclosure, but I'd like to go through the closing disclosure first, and then we can talk a little bit more about how they interact with each other. So I'll bring up the closing disclosure now. This document is 5 pages long as opposed to the 3 pages of the loan estimate. And again, it combines the HUD-1 and the final till. The interesting thing about this disclosure is who's going to fill it out, who's going to deliver it, and the headline is obviously how many days prior to closing it has to be in the consumer's hands. And we'll talk about all that. If you notice at the top of the closing disclosure, you're going to see a screen that looks a lot like the loan estimate. It's not identical, but it has your key information, the date it was issued, the closing date, the disbursement date. It talks a little bit about the borrower and their information, and then obviously the loan information. This loan product information is key in the upper right-hand corner, and we'll talk a little bit more about that. The loan terms and the projected payments tables track to the loan estimate, so they should look pretty familiar. And again, no surprises. And then the cost to close, estimated cost at closing. So let's go to page 2, where there is a little bit more detail. Page 2 looks like a HUD in some ways, but doesn't track to the 700, 800, 900 series, etc. That we're used to seeing. Instead, it goes back to the A, B, C, D categories that we saw on the loan estimate. It also requires alphabetical order, just like the loan estimate, and you'll see the borrower, seller, and paid by other categories that I think bring a little bit more clarity than the HUD one today. So to the extent that that might give us a better picture of some of these fees, particularly seller paid fees, I think that's important. The other thing you'll notice is that the provider is prominently displayed. Looks very much like your HUD one, but it's going to shine a little bit of a brighter light on affiliates, as I mentioned with the tolerances, but also with our settlement provider list. The fact that you must provide a written list of settlement providers and that they've clarified that rule a little bit means that they'll also be looking at whether or not the borrower chose that settlement provider and what that means in this section, particularly B and C, when the services the borrower can or cannot shop for. But you'll see, again, very self-explanatory, alphabetical order, going to track back to the loan estimate. Your other costs, again, I don't really need to get into this, but you'll see the provider column is still there, alphabetical order, and the 3 columns. Moving on to page 3, this is where you see more of a summary of the transaction. You have your cash to close information at the top. So you can, according to the CFPB, you can use this table, compare it to the loan estimate, and see what has changed in terms of closing costs, deposits, funds to the borrower. These are all calculated and displayed on this table. Below that, you have the summary of the transaction. The summary of the transaction gives you that snapshot of what's been paid, what's due, what's going to be paid. It's what the settlement agents and settlement attorneys will be relying on when they compare their information to the contract information to the seller's attorney information. The action's going to happen here. And then at the bottom, your cash to close. You see the calculation for the borrower, calculation for the seller. That's your picture of what's going to happen at the table. Page 4 is your final till information and some other sort of newly added disclosure information. Again, as I said, there weren't a ton of changes, but there are some here. One of the things you'll see is the usual information about assumption, late payment, and negative amortizations here. Some escrow information, whether or not there'll be escrows, and then in the future, your options around escrow. You'll see that they really tried to make this an educational portion of the document, I think more so than the till today. But generally, this is information you could already get from our transactions today. So there's not a ton here I would be worried about. And then page 5, you have a couple of things I want to highlight here. The first is you'll see this large box right in the middle, questions. The CFPB is actually putting an ad in this document that says, if you have any questions or concerns, please see the consumerfinance.gov website, submit the questions to us, we're interested. I thought that was interesting. And also, this is worth noting at this point that the GFE, the HUD-1, the 1003, Those are all examples of model forms. The government never made those mandatory. They simply put them out as model examples you could use. Now, the secondary market, most creditors in the country went to those forms anyway, because once the government's going to put out a model form, you might as well use it. But they didn't do that with these forms. These forms are mandatory. So every lender has to use them, which means every lender's closing disclosure has this shout out to the CFPB on it. The other thing you'll notice is the total interest percentage makes an appearance again here. And then you have your other disclosures about your appraisal, your contract details, some liability around foreclosure, your tax deductions. And then the other two boxes, the final two boxes, one in particular, the contact information, I think is an important note. If you're in the wholesale business and you work with mortgage brokers, anyone who works with real estate agents, realtors, their information is now prominently displayed and trackable on this form. What I mean by trackable is nothing's changing with the fact that you have to put all this information on here, but certainly folks that haven't been closely tied to this transaction, at least by name, number, and location, are now trackable. So your lender, mortgage broker, real estate broker, buyer, real estate broker, seller, and settlement agent are all provided right there in a nice, neat table. I think that would be something to highlight if you're doing outreach to your real estate agent partners, your referral partners. This is something they're going to need to take a look at and at least know, hey, you're going to be prominently displayed on this document. And then lastly, again, the confirmation of receipt, this signature line. I cannot imagine not having a borrower sign this document, not having every borrower sign this document. You want the CFPB to know that they got this 3 days prior to closing and that we have the document signed. So 3 days prior to closing. This is the big headline, I think, around the closing disclosure, and now's a perfect time to get into it. The document must be in the hands of the consumer 3 business days prior to consummation, prior to closing. The catch with in the hands of the consumer is it creates a delivery issue. You have 3 options to deliver the document today, and under this rule. In person, in the mail, U.S. Postal Service, and via electronic disclosure the way you would with a GFE, a redisclosure, and a package today. Here's the catch with each one. Each one has its own pros and its own cons. If a lender chooses to mail the disclosure, it is by far the most reliable way. The CFPB has seen fit to trust the U.S. Postal Service and say they will deliver this in 3 days. You can assume, without knowing for sure, that this was delivered in 3 business days. The catch is, the consumer also has to have 3 business days to review it. That's the whole point of the rule. So now you're talking about a policy, if you choose it, where you mail the disclosures, you need 6 business days prior to closing. 3 for the U.S. Postal Service and 3 for the consumer. That means all the fees must be finalized 6 days before consummation. If you choose in person, so you say, that's too many days for me, I'm going to do in-person delivery. Great. Who delivers that document and how do they get the signature that we have it? Is it going to be the loan originator? Is it going to be someone from operations? Who's going to do it? The settlement attorney? And if so, what are they charging for that? So there's a lot of questions around in-person delivery. While the most secure in knowing for sure it's in the borrower's hands, it creates some logistical and cost challenges, and I'm not sure how each lender is going to handle that. Lastly, electronic disclosures. Electronic disclosures is by far the most convenient. It's the easiest for the lender. You put them in the email. The catch is the clock doesn't start ticking until the borrower has acknowledged and e-signed. So you could send out the disclosures 3 business days prior to closing exactly as you plan to, and the borrower doesn't get that email, or they're not home to accept the email, or they haven't been able to sit down and understand what they have to do. If any of those things are true, the clock hasn't started ticking. You can't schedule the closings. Are you going to have 6 to 8 people calling the borrower, peppering them with texts and emails saying, or text and calls, saying, check your email, you got to click, you got to click. And if so, we're all in limbo until they do. On the other hand, they didn't put a time frame around the borrower accepting the closing disclosure via email, meaning anytime up to 11:59 p.m., if the borrower clicks, that day is counted. And likewise, as soon as it becomes the 3rd business day, or the 4th business day essentially, they've had it for 3 days, at 12:01 a.m., essentially, you can have the closing. So they did do 3 business days, but any time those days counts. So I think that is somewhat helpful if you're going to go the route of electronic disclosures. Again, we're not specifically talking yet about what Norcom's going to do, but know that there'll be more information coming out on that because delivery of this document is going to be really important. Coordinating with the closing attorney for the seller's fees and all the fees is also going to be really important. It is Norcom's responsibility and it's our liability if we don't process a fee, reveal a fee, display a fee, disclose a fee properly. So as a result, a lot of lenders, and some publicly, so I can say it here, Bank of America, Wells Fargo, have come out and said, we're going to handle not only the delivery of the document, but also the responsibility of everything on it. Our settlement agents will not have delegated authority to mess with the document. That's certainly the most protectionist view, but it also creates a problem where if something changes that doesn't trigger a new 3-day waiting period, who's there to edit the document? If it's going to be somebody at the lender, do you have somebody in closing prepared to make the necessary changes and get out a new closing disclosure? So you can revise a closing disclosure without triggering a new 3-day window as long as one of 3 things hasn't occurred. The 3 things that will trigger a new 3-day waiting period for the closing are a change in loan product. Now the good news is they're talking about the top line loan product definitional terms, FHA to VA to conventional, the 20-year to 30-year, fixed to adjustable rate. So a major loan term or condition has to change to trigger a new 3-day window. But the truth is, if one of those things is changing that close to closing, you're probably going to have a delay anyway. They've also said any change to prepayment penalties triggers a new 3-day window. Not a huge deal for Norcom as we don't have prepayment penalties, but to the extent that lenders do, any change to those will trigger a new 3-day waiting period. And lastly, they've maintained the language in Truth in Lending around the 1/8 change, the 0.125 change to the APR. So if you have your finance charge and your APR changing and the APR goes up or down by more than 1/8, they've maintained that language in the rule, and that will trigger a new 3 days, but it already does today. Those are the big 3 that will change a new 3-day, that will create a new 3-day window. Now, when the rule first came out, we were all nervous that any change would trigger a new 3-day window. So the oil tank adjustment here in the Northeast, is that going to trigger a new 3-day window because the borrower may have more cash or less cash and it changes the borrower's position? But what they've said is you don't have to wait a new 3 days, but you do have to issue a new closing disclosure to reflect that. So who's going to do that, how quickly, is also going to be an important factor in on-time closings. And then I'll get back to the real estate agent part of this later, but that's a factor where we really need to work with our partners to get the culture of this rule changed. But let me talk a little bit first about how the closing disclosure interacts with the loan estimate. What I mentioned earlier about the loan estimate having to be issued and then after a certain amount of time, and then the closing disclosure must go out at least 3 days prior to closing. The catch is the loan estimate cannot overlap with the closing disclosure, meaning once you've issued a closing disclosure, you cannot issue a revised loan estimate or another loan estimate. The only loan estimate after the initial package that is absolutely required is at rate lock. The rest are permissive, meaning if there's a changed circumstance under RESPA the way there is today, you would issue a revised loan estimate reflecting the changed circumstance. Those are all permissive because you don't know if there's even going to be one. There likely will be, but not necessarily. However, at rate lock, they have said that you have to issue a revised loan estimate reflecting the lock within 3 business days of lock. Again, we do this today with GFEs and TILs, but one thing that's important to note is that once you've issued your last loan estimate and you begin preparation and disclosure of the closing disclosure, they can't overlap, which means in order to get a locked rate and the disclosure out in the hands of the borrower prior to disclosing the closing disclosure, you may be at least 5, 7, in some cases 8 business days prior to closing, because you have to be able to lock the rate, that's a day, issue the revised loan estimate either same day, next day, but you have within 3 business days to do so. The borrower has to confirm receipt of it, Once that happens, you can issue a closing disclosure. So hypothetically, if everything went perfectly, you could lock a rate 5 business days before closing, issue the loan estimate 4 business days before closing, and the borrower receives it on the same day, issue the closing disclosure 3 business days prior to closing, and close the loan. I don't see that happening in a lot of shops or happening that smoothly all the time, even if it does once in a while. So what's going to happen for most lenders is you will see revised policies and procedures or considerations around rate lock, because you need to buy yourself the time to confirm the delivery of that revised loan estimate at rate lock, properly prepare the closing disclosure, and deliver it to the borrower. So that's one area that not a lot has changed, and at the same time quite a bit has changed. The other thing I think is important to note here is just the culture of this rule in general. So you have 2 new forms. We have to do a lot of data mapping. Brian and his team are going to be working hard with Ellie Mae to make sure that we get all of our data fields correct. We get to test drive in the coming weeks this disclosure model and what it looks like and how it feels when we visit Ellie Mae. So we're going to get a lot more information in the next few weeks that we'll be able to pass on to you about how the tech side's going to work. But even once those are mapped, there's still a lot of issues around communication with the borrower, with your real estate agent partners, with closing attorneys. How this information gets transferred to the market is going to be key. One thing that the head of Wells Fargo's closing and compliance department said, and I always give Penny credit for this because she said it at a conference, and I want to always let her have that, but I always repeat it everywhere I go because I think it's really important. Historically, particularly in Connecticut, an attorney state, Massachusetts, another attorney state, this has always been a contract transaction that occasionally has financing. Meaning the buy-sell aspect of it, the purchase contract, drove the entire transaction, and that's always how it's been treated. Today, this is a financing transaction that occasionally has a seller. What do I mean by that? The CFPB named this rule, know before you owe. They didn't name it know before you buy. And as a result, I think they're looking at it as a financing rule. They're looking at the transaction as a financing transaction. So this really is becoming the lender's responsibility to keep everything on track, keep everything in order, but we also take on the liability as a result. So communication, when I say communication is key, it's an understatement. We need to set proper expectations with our real estate partners that certain timetables are important, that the borrower has to be active in the process so they know when to check their email or when to meet with whomever is going to deliver the form. And I think they also need to understand that we have communication with settlement attorneys that has to be lined up. The seller's attorney is going to be involved. You could have chain closings. This rule has tentacles that go into a lot of different areas of our business. And whereas the qualified mortgage rule that you heard me talk about last year this time, that was actually in effect last year this time, we've been talking about it for 18 months, was much more a credit underwriting guidelines rule. It was about qualified buyers and sellers. This rule in particular is more operational in nature, and as a result, the borrower might not be privy to a lot of behind the scenes things going on, but they're going to happen to have these transactions go off smoothly. Another thing I want to bring up is a temporary problem, but is potentially a major problem. And that is the CFPB has said that any transaction that begins with a GFE and a TIL has to end with a HUD-1 and a final TIL, which means your application taking on July 31st, 2015, will have a loan estimate, or excuse me, will have a GFE and a TIL. That loan may close in late August or even September, must close with a HUD-1 and a final TIL. The very next day, your application will be disclosed with a loan estimate, August 1st. That loan will also be in the pipeline and must end with a closing disclosure. So for 6 weeks, 8 weeks, whatever it is, we're going to have 2 sets of loans in our pipeline. And you're going to hear a lot in closing with your processors. Is this a HUD closing or a closing disclosure closing? That is going to be a problem. The coordination of that, what documents are proper, you can't mix and match. So there's a lot of operational challenges, a lot of logistical challenges, and a lot of them go to the culture of our business, which makes them even more challenging when we start talking to people outside of Norcom about what's going to happen. One of the things I hoped that these sessions and this video will do is set the stage for all of the phases that are to come. You're going to hear a lot from me, from Brian, from Norcom, about what we're doing in the system, what we're doing from compliance policies and procedures, and how we're going to manage the training for each of your departments. But this, I hope, was helpful to set the stage, to say, here's what we're looking at, here's all the different nuances at play. It hopefully introduced you to some things you're seeing in your email, you're hearing. You may even start getting questions from your partners. We're available. I'm always available. Send me your questions, send me your comments. We want to give you as many resources as we can. This is just the first in many where I'll push out as many helpful hints, tips, trainings, and then obviously as we get the technology up and running, we're waiting for Ellie Mae to send us some opportunities to do that. But over the next 6 months, you'll see a lot coming out from us of those. If there's anything we can do to help, let us know. And if there's anything I missed, you can bet I'll be following up an email. So please feel free to contact me in the meantime, and I really appreciate your time. Thank you.
So what did you learn today, DeLynn?
Wow, that's a lot of information. I just love the way Jeremy breaks it down. He just makes it so easy to understand, don't you think?
But
I know, but it hurts.
My brain hurts. I was thinking we were going on summer vacation. August 1, we're on the cruise. We're going to Wally World. No. It's all different.
And as Jeremy says, there are going to be some changes. And of course, our is to keep everybody up to date. Our goal.
Because we're informative.
We will keep you posted between now and August 1st. Lots, anything that comes out, any of the new stuff. So we're probably going to be boring you to tears with all of this new stuff that's coming out. But we want to make sure everybody's understands it, because then closings and everything will go much smoother.
Yes, and
expectations. It's all about setting the right expectations.
Yeah, and we will move forward as we always do in this industry with another change. But you have to be prepared for the changes. So now more than ever, we ask that you share the show. Yes.
Share the show.
Get
Facebook.
it out on Twitter. Are you stealing my thunder?
Go.
Yes, you are. Get it out there on YouTube, Twitter, Facebook. What else do we? LinkedIn.
That's what you have to ask me anyway, right?
You're right. Did you know that LinkedIn has the highest level of income earners? People who have LinkedIn profiles make more money than any other.
Definitely share it on
LinkedIn.
Share it on LinkedIn. we don't want to forget that one.
Anyway.
But we appreciate your watching. Please get this out so everybody knows it. And that's it. We are today and every day
moving forward.
We'll see everybody next week. Bye-bye.
Ciao.